Good morning, everybody, and thank you for joining us on our first breakfast seminar, Weathering the Storm, the approach to a hard D&O market. Over the past 15 years or so, we haven't had much to say to you beyond your premiums are decreasing and your coverage is broadening. Clearly, times have changed if any of you have gone through an insurance renewal right now. The past year saw the D&O market dramatically change, and it was a market that most of the underwriters, the brokers and the clients have never witnessed before. Almost overnight, our capacity was cut and our premiums were increased. It wasn't limited to an industry class, and it wasn't due to a market event. By the end of 2018, almost every renewal we saw, the clients had had their retentions and their premiums dramatically increase, and that trend seems to continue. Our panel this morning is hopefully going to offer some insight to what has happened and how we can weather this storm going forward together. They're going to answer a few questions that I have for them.
So I think probably a large influencing factor in how we got here is actually the development of the claim trends over the last few years. As Chrissy mentioned, there's been dropping premiums, there's been broadening coverage, but actually there's been a huge development in the way in which claimants and shareholders and people are acting. The claims themselves have developed hugely. If you look at the securities actions, particularly in the US, partly in Australia, you look at the behaviour of the regulators on a global basis largely, whether they be US, UK and almost anywhere else, they're more aggressive. And the cumulative effect has led to claims costs hugely increasing. The complexity has developed, and even if you're looking at a securities action, you're talking about potentially millions of dollars of defence costs, a couple of $1 million before you even get through to phase one of a motion to dismiss. And this cumulative effect across the market has led to some very difficult times for various underwriters.
I think one of the things that we've been looking quite carefully about, we as a market talk quite a lot about the US securities exposure because a lot of that data is publicly available, so it's much easier to talk about. The trends are well known. I think we've been trying to focus quite a lot on the rest of world exposure. So the UK domestic exposure, the regulatory exposure, things outside of just the securities exposure that are coming under a D&O policy. If policies have expanded, the number of claims that have been able to be filed under them has increased significantly. And certainly if you think about the prior year reserve strengthening, that's on some years where the policies are not as broad as well. So if we think about, we have increasing claims of those classes we know about, things like securities claims with everyone expected to be covered under a D&O policy. We've got broadening policy terms and conditions in the last 5 to 6 years. And the increase in claims costs, those three things coming together are really dramatically affecting people's profitability. I think one thing I wanted to point out that both Gareth and Yoel pointed out was the increase in the cost to defend these claims. So even if the same exact claim came in 5 years ago, the cost to defend those claims now has increased dramatically. So we were looking at the figures for SFO claims. We used to think that on average it would cost about £1.5 to £2 million per director to defend an SFO prosecution through trial. The average now is probably about $3 to $4 million. So if certainly the price we're paying for policies has not dramatically increased that much. If you think about the reserve strengthening, we weren't building that pricing in then. And just the cost has more than doubled. But we had a case where a single director recently put in a budget for an SFO prosecution of $16.5 million just to defend one director.
From a reinsurance perspective, the racing environment has been soft for a period of time. Local markets have been increasingly competitive and are retaining more of the risk locally. There has been some variance in terms of underwriting discipline from a risk selection, from a pricing, and from various standpoints, and the terms and conditions have broadened as a result of that. So as market conditions have deteriorated, loss ratios have gone up.
The cost of representation for investigations has also gone up exponentially. It might also be because of the number of insured persons being brought into these investigations, the global nature of these investigations. We're looking at a few in the UK at the moment, which are pretty much ring-fenced to one country. There's a lot of political pressure to find an outcome. They're going to be much faster investigations. If you look at an FCPA investigation, they can be global. They can look into numerous different territories, jurisdictions, requiring lots of different interviews with insured persons in different countries, translation costs. Those ones typically are far more expensive, and by far more expensive, I'm talking many tens of millions of dollars. I've seen at least 3 entire programs being fully exhausted just on investigation costs prior to any civil or criminal suits.
And from a macro perspective, again, if you look at the financial crisis, very few individuals were held accountable. And there is a groundswell of public opinion both in the USA and in the UK, and Australia to an extent, that they want personal pain. And so post the financial crisis, if there is bad behaviour, governments are going to seek to pin it on 1 or 2 individuals.
I think what clients can expect this year is exactly what we're talking about. We are looking at limits, we are looking at retention, we are looking at pricing. The entire kind of paradigm that came before has been proven incorrect. So a lot of what we're talking to people about is, people call it re-underwriting, call it no grandfathering. There's all kinds of terms being thrown around, but we are looking at all of the risks in the context of the claims that have come in over the last couple of years, which, as you all said, relate to, 10, 12 years of policy periods. So I think the pricing that you had before is not the pricing you will have going forward. And I think that will be a sustained change because it's a 10, 12-year trend, those claims. So I don't think this is a 1-year correction and then we're done. And there's no reason to think that the litigation environment is going to get better or that regulatory investigations are going to be less frequent or cheaper. So I think it's only going to increase from there.
I do expect as this year progresses that insurers will probably start even more so looking into specific areas where they're making more money than others, or losing more money than others, I should say, at this time. So you might end up with more granularity in the approach taken by the market. That would be interesting. And I would also suggest that may be a new norm as well. So more data, more granularity in the way that we approach risks.
Reinsurers are seeing elevated loss experience in the US, in Australia, in Europe. And that's been partially driven by the increased frequency in class actions that have to be defended. So that will feed through to the reinsurance programs that insurers purchase and will ultimately feed through to the programs that buyers of insurance are purchasing. So generally speaking, reinsurers feel that the business has been underpriced for a period of time and see what we're seeing now as a form of price correction. So by that logic, you could say this is the new normal. Alternatively to that, you could argue that you're looking at more of a 2 to 3 year time horizon of elevated pricing, and if prices stay elevated and loss experience becomes more benign, it will look more attractive to those outside of the market, which may cause capacity to flow in, which will naturally drive prices down. So there are arguments for both sides of that coin. Interestingly, during previous periods of elevated loss experience, the commercial D&O space and the FI D&O space have acted to counterbalance each other. So if one has experienced more a negative loss environment, the other has been able to pick up the slack to smooth the experience for D&O as a whole to some extent. Now reinsurers are looking at each element on its own merits. Reinsurers are doing that and Lloyd's are doing that from an oversight perspective, and that's unlikely to change. So what I would say for 2019 and beyond is keep an open dialogue with your broker and with your markets, and that'll help you plan more effectively for the future.
I don't see the volatility changing. I don't see the claims environment becoming more benign. I don't see lawyers cutting their rates dramatically. So I think we're in a bit of a new normal, but I do think we will see the insurance market become more creative.
There's a long period now of underwriting discipline and understanding of what the exposures are, which we hadn't previously experienced, to be completely fair, and over time a more granular approach to risk selection and the insurance provision. So, and I think that's exciting.
if you engage with your underwriters, engage and be as open and honest as possible, that helps. Your program structure, you can sometimes confuse underwriters by mucking around with the program. Very much moving people around the program, that will help. You need to arbitrage the underwriters. Not all underwriters think the same. They're all humans. The stance that Stephanie takes and the stance that UL takes doesn't flow all the way through their organizations. They have a broad spectrum, but clearly on any given day, an underwriter will make a decision based on how they feel about the account, and that can be helpful. And then the last thing that you really need to employ is an awful lot of game theory with the market, because there's not a lot of competition. It's not a perfect market at all, and you have to be very, very selective in which carriers you want to write the program and whereabouts on the program in order to get it finished.
It's important to try to foster long-term relationships and have a really deep understanding of the organisations that we provide insurance for, and I think that kind of long-term engagement really, really helps. You build loyalty that way, both from obviously the client who trusts you to pay in the event of an event circumstance, and from the insurer side on the basis that they feel indebted and committed long term, and it does to some degree mitigate some of the swings that we're seeing. Others are really just asking your broker and consultants to really explain some of the exposures early and to understand what particular hotspots there are for underwriters.
I think to complement some of that as well, that some of those themes carry across to the scenarios where potentially you're going to experience a claim or a circumstance or an issue. And the points about early engagement and actually partnering with insurers, treating them as a stakeholder in that process is even more important in these times where it is very hard and it is becoming more difficult.
What happens with the engagement, the early engagement and understanding of the risk, it just means that in terms of the underwriter is able to ideally band the company into a bracket which is perhaps perceived to be less high exposure. So say you're in the pharmaceutical industry, you're US traded, it's a massive red flag to the market. If you're in medical devices, perhaps less so than pharmaceutical prep or biotech.
As part of being creative about programs, look at individual terms and conditions. I don't think there will be a wholesale, people will come out, Excel or AIG will come out with a new form that's dramatically reduced cover. But I think on individual risk, you will see people say, well, this is an area of concern for us with you. Therefore, on your account, we're going to sublimit this aspect of cover. We're going to remove this aspect of cover. I don't think you'll see the entire market dramatically taking out pieces of cover that are in the forms, but I think you'll see more risk by risk, looking more carefully at the terms and conditions.
I'd agree with that. I think it's also an opportunity to be kind of creative and mitigate some of the price increases. If you have an exposure in your industry, if you can look to sublimit it or co-insure it or exclude it, you can get options from the market, and they will hopefully offer some mitigation to price increases.
The wordings now, the development and expansion of them over the last few years have got them as close as they can be, I think, to really aligning, particularly with some of the way the regulators operate. For example, there were claims that we were dealing with 6, 7, 8 years ago that were probably based on how regulatory authorities were operating 10, 15 years ago, if you like, and as I mentioned earlier, their general modus operandi now is largely different to how it was before, and wordings need to evolve, if you like.